Welcome to the Capital News. I'm your host, Alex Karitis. Today is Thursday, March 4th, 2021. Thank you so much for joining me. Title of today's podcast, Jobless Up in Yields Up. I'm going to continue to say that jobless claims are up until we at least get back to the levels that we saw during the depths of the great financial crisis. And then I'll have a title that says, jobless claims reach GFC levels, and everybody will be like, oh no, everything's terrible. Not realizing that we've been far worse than the depths of the GFC for the past year. People don't realize how bad this situation is. So it's Thursday. We got the Department of Labor numbers with initial jobless claims. Number comes out at 745,000 for last week. And last week's figure was revised upward by 6,000 and is now 736,000. So we are still nearly 100,000 higher than during the depths of the GFC. And we are now basically one full year into this mess. Okay, now of course there's a lot of chatter. Other states, some big states, the news with Texas and some other southern states really starting to open up, or they want to. Of course, we'll see what happens. They will. It'll be interesting to see if cases or hospitalizations or both start to go up, and then boom, presto, right back into some sort of lockdown or restriction. I mean, this has just been monkey in the middle for the past year. The economy needs to be opened up, period, end of story. I can understand early on. We've had this conversation many times before. Early on, you understand it. But once you start to collect data and understand what's going on here, and furthermore, when you tell businesses, especially small businesses, here's what you have to do to open up, these businesses do so, and then they shut them down again. That's just completely wrong. And of course, the small businesses are the ones that are just getting shellacked. Target, Walmart, Costco, Amazon, they can stay open. They're necessities. They're important. But the small businesses, the family businesses, nah, you're not important, you're not necessary, shut down. But don't worry, we're going to pass several versions of a Nobody Cares Act for you with billions and trillions of dollars that we do not have, and we're going to give it to you. Oh, well, that's what we're going to tell you, but we're actually not going to give you that much of it. Most of that money is going to end up making its way to larger companies. Yeah, that's just how that's going to work. So you're going to lose your livelihood. You're going to lose everything you've put your life into. But don't worry, wear a mask. And now, of course, they're telling us to wear 2 masks. This is beyond ridiculous. Why don't we wear 22 masks? If 2's better, 22 has to be fantastic. Has to be fantastic. So this, to me, at this juncture, and honestly, I mean, it's been well before this, but this is basically just a psychological experiment right now to see how far they can go with our restrictions, what they can tell us, blah, 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 blah. That's honestly what I believe this is. I think it was the Milgram experiment or something like that, sort of a question as to how far people will trust an authoritarian figure. Okay, look that up. It's an interesting study. If I remember correctly, that's the name of the study. But anyway, bulk of today's discussion, jobless rate, at least initial jobless claims, and yields continue to go up. And of course, we had Jay Powell come out today and make some comments, and we're going to focus on that. And that's maybe some of the reason why yields went up and why stocks sold off today. And it's just becoming more and more par for the course because, as I've been stating here for weeks, it is all about the narrative. So central bankers, politicians, but primarily right now it's the central bankers, obviously, when it comes to the economy and the markets, what they say. And isn't it a sad shame when you have a handful of people around the planet who can move markets to such a degree? That type of power should never really exist within any sole person. It just shouldn't. And if it does, then that power should be restrained. It should be used minimally. And every time one of these morons opens their mouth, the markets are just waiting to hear what they have to say. We're going to cut rates. We're going to increase rates. You're going to do Operation Twist. You're going to do yield curve control. You're going to expand quantitative easing. What you going to do? Not about the customers, not about the health of the economy, not about innovation and entrepreneurship. None of that. What are a bunch of eggheads that call themselves central bankers? What are they going to do? Remember our podcast maybe a few weeks ago? It's a central banker's world. That's all it is. They are in charge. And that sickens me, especially for this country. Because we're supposed to be a system based upon checks and balances. Nobody overrules them. For all intents and purposes, nobody oversees them. They are not elected. They're accountable to basically nobody. They make a bad decision. They keep their job. Nothing happens. To them, to the economy, people could lose their lives. They could lose their livelihoods, I should say. Lose their business. Lose their homes. Lose their cars, etc., etc. Oh, but we're just experimenting. We're just experimenting. It's a wealth transfer. Don't you get it? We have to look out for the top 1%. Because that's what this is. It's just a huge wealth transfer right before our very eyes. But what does the 24/7 media have you believe? Well, they don't even pay attention to this stuff. They don't even pay attention to it. They don't call this out. In fact, they continue to applaud these central bankers too. But most of the news is about the political circus. Oh, did you hear what this guy said over there? He's a Republican. Can you believe he's a hypocrite? Or some Democrat over there. Can you believe that she's a hypocrite? Can you believe it? Wow. Mind-blowing. Mind-blowing. Who would have thought politicians on either side of the major parties would be hypocrites? This is what they feed you all day long. Have you not woken up to this fact yet? And I hope you've left the parties, because they're a disgrace. And we're going to likely get the $1.9 trillion monstrosity. Senate version, I guess, was passed earlier today with Vice President Kamala Harris being the tie-breaking vote. So there's still another rigmarole to go through, but it's coming. It's coming. And Republican Senator Ron Johnson out of Wisconsin, he said, well, I want to delay it a little bit, so I'll have the Senate clerk stand up and read the bill, which is some 628 pages or something like that. Boy, I get that guy is not too happy about his job right now. Oh, this is what we do. It's a circus. We are a banana republic. How much more do you need to see? Market performance, the dollar index is at 91.72. 91.72. So flirting with the 92 handle. We have not been at this level since last December, November. Okay, so the dollar index might be breaking out. We're going to pay attention to this closely because upward pressure is likely going to put downward pressure on U.S. stocks. Bitcoin is at $47,000 per coin. Not a whole bunch of movement overnight with the major currency pairs, so we'll let that ride. Overnight futures trading, the Dow Jones and S&P 500 are both flat. The NASDAQ 100 is down about 0.2%. Japanese cash trade giving back 0.5%. A mixed bag across the pond in Europe today. Australian cash trade giving back about 0.7%. And Chinese stocks are currently flat. Then on the share price front, Apple gave back 1.6% for the day. Tesla gave back 4.9%, trading at $621 a share. Microsoft giving back 1/3. Amazon giving back about 1%. Facebook was in the green, up about 0.9%. And the big gainer for the day was ExxonMobil, up 3.9% on the back of stronger oil prices, backed off of from an OPEC meeting. So we have WTI at $64.90. Brent at $67.92, so flirting with the $68 a barrel level here. Natural gas, $2.72. Gold and silver getting shellacked today. Gold, $1,697 an ounce. Silver, $25.22 an ounce. Copper was actually below $4 earlier in the day's session. Right now it is at $4.05 a pound. So a lot of this obviously is off of the back of a stronger dollar, at least for the time being, and off of the increase in yields as well, where we have Uncle Sam's 10-year note at 1.56%. So flirting with where we were last week, but that was intraday when we hit 1.61%. That was intraday trading. We had a close at about 1.5% today, pretty much off of the back of Jay Powell, chair of the Federal Reserve, his comments, basically saying what they've been saying, that he believes that inflation is likely going to peek its head out of the hole, and it's only going to be transitory, so temporary, and we're ready for it, and we have the tools in our toolkit, because they have the tools for everything, right, to handle it. I don't think so. I don't think so at all. And really, I think this is more about a narrative. You know, with the markets going down the way they are, is this simply a correction? Is the Fed trying to cause a bigger sell-off so that they can come in and justify an Operation Twist or yield curve control? An Operation Twist, of course, is something they have done before. So Operation Twist would be something, okay, they are going to sell short-term treasuries. Price go down, yield goes up on the short end of the curve. But then they're going to buy the longer end of the curve, 10s, 20s, 30s, to get those yields back down. So the Fed needs a story. They need a narrative. They need some sort of justification. Well, a typical run-of-the-mill correction in the stock market probably isn't going to be enough. But if it gets a little bit more significant, a little bit more severe, especially in its rapidity, well, then the Fed might think, okay, we have the cover to come in and actually do something and to say something in a couple weeks following their FOMC meeting. All right, so that's what markets are going to be paying very close attention to. Again, it's a travesty that we have trillions of dollars that are waiting in the wings to hear what a handful of idiots have to say. So don't ever tell me that this is a free market capitalistic system. You don't know what the hell you're talking about if that's what you're going to say to me or anybody else. Oh, this is free markets. This is capitalism. No, it isn't. This is centrally planned and controlled. You have a handful of lunatics running the asylum. And they show their faces all the time. And the media and politicians kiss their butts. They're plastered on the cover of magazines. That's how ridiculous all of this nonsense is. And it's only going to get worse. Wait till they pass the 1.9 trillion monstrosity. They're already talking. Uncle Joe, Sleepy Joe Biden is already talking about infrastructure. We've been talking about that the past couple of days. American Society of Civil Engineers gave us a grade of C-. Now, that's the best we've had since they've been keeping track since 1998. But to me, that's still pathetic. And it's still going to take trillions of dollars worth of spending to get it to where it needs to be and where it should be. They're just getting started. So they're going to work on infrastructure. That'll be next. That'll be hundreds of billions, if not trillions of dollars. Green New Deal, healthcare, and God knows what else. Okay? Just getting started. But these yields are obviously of concern. Where's the 30-year? Let me take a look at the 30-year. 30-year is also up here, 2.32%. 2.32% on the 30-year, the long bond, and we haven't been there since last January. And, of course, last January it was on the downslope. This is on the upslope. And, of course, what's so important about the 10-year yield is that it is linked to so many other financing schemes, such as mortgages. So we have a housing market that is on fire, prices at all-time highs, and we have mortgage rates that are starting to come off of their all-time lows and actually have hit 6-month highs. So that's not a recipe for success if these yields keep going higher. So something is going to break, something is going to give. So if the Federal Reserve wants to come out and claim, like Jay Powell did today, that they can contain inflation, well, the only way they're really going to be able to do that is to increase interest rates. And we know how delicate our system is because our markets, our financial markets, are in a bubble, okay? Pretty much across the board. So if they increase interest rates just by a hair because of the fragility that exists within the system, it's going to pop. It's going to pop. That's why I always remind the audience as to what took place in the fourth quarter of 2018. We had a bubble in financial assets then. That's why we saw a 20% decline very fast in the fourth quarter of 2018, all because interest rates started to go up and because the Federal Reserve was tapering its balance sheet, which is basically the same thing. Okay, it has the same effect. This is not a strong, solid economy. It's just not. And with the dollar index rising, well, a lot of that is just relative trading. It's perhaps the market buying in, at least for right now, that the Fed is still in control, that other markets, that other countries, other economies are not as strong, so the U.S. dollar gains traction against them. It's all nonsense. It's all rigged. We know this. So it's just strap in, buckle up, and get ready. That's all it really comes down to. Initial jobless claims for the week ending February 27th, seasonally adjusted, 745,000. As I stated at the top of the podcast, the week ending February 20th number was revised upward by 6,000 to now stand at 736,000. Initial jobless claims non-seasonally adjusted for the week ending February 27th come in at 748,000. Continuing jobless claims seasonally adjusted for the week ending February 20th lags 1 week, about 4.3 million. Non-seasonally adjusted, 4.8 million. For the week ending February 27th, Pandemic Unemployment Assistance, the PUA program, is now standing at 437,000. That's a week-over-week increase of about 9,300. For all Americans claiming some form of unemployment insurance, regular state, federal employees, newly discharged vets, PUA, PEUC, extended benefits, state additional benefits, workshare gives us a grand total of 18 million in change. This is a week-over-week decrease of 1 million in change. So that's in the right direction, and that's for the week ending February 13th. Recall the grand total lags by a couple of weeks. The biggest decreases came from regular state, week over week, a decline of 140,000. PUA, a week over week decline of 192,000. PEUC, a week over week decline of 600,000. And extended benefits, a week over week decline of 83,000. So if you take the grand total of 18 million in change, you're going to get about 12.7% as a de facto unemployment rate. And of course, tomorrow is Friday, so we will have the official jobs report come out, released by the Bureau of Labor Statistics. And it's anybody's guess what's going to happen there. The last couple of reports have not been great. Revisions were not great. It's really a question as to whether or not people are back into the workforce or if they continue to leave the workforce. Because that's the interesting thing with these dynamics and how these numbers are calculated. Because you could, ironically, of course, have the official rate increase if you have more people in the job market looking for work, because now they're going to be counted. Conversely, if more people have left the workforce, they've left the labor force, and are not looking for jobs, well, then they're not going to be counted. So there you could have the unemployment rate continue to drop, which is what we have been witnessing. That's why this is all shenanigans. Okay, so we're at like 6.3%, something like that on the official number. Jay Powell a couple weeks ago says, no, it's closer to 10. It's all hogwash. It's all about the narrative. That's all it is. That's all this is hanging on. Will the markets continue to buy it? And that's all it is. If the markets continue to believe that central banks are in control and that federal governments can continue to spend money that they don't have and nothing's going to break, then markets are going to keep going up. Stocks will keep going up. The bond prices will keep going up. There's no ifs, ands, or buts about it. If the market continues to buy the baloney. Once the market no longer believes it, then it could be the beginning of the end. Because that's just going to show that the Fed and other central bankers do not have the tools in their arsenal. They do not have the type of control over the markets that they claim to have. And it's game over. It's game over. Might not happen overnight. I don't anticipate that would be the case. Although, you never know. But what you are going to see is obviously the revolutions, the coups, the protests, the high rates of inflation, societies and economies and markets breaking down. The weakest links always go first. We rattle those names off here all the time. It will continue to pick up steam. It will continue to pick up momentum. You have that snowball effect. It will start to knock on larger economies. That's what's going to happen. You cannot stop this moving train that they had set in motion, and it's packed with dynamite. Okay? This is not going to end well. Now to the Fed's balance sheet. $7.557 trillion. So let's just say $7.56 trillion. This is slightly below last week's figure, but still flirting with all-time highs. And of course, this number is expected to hit at least $8.5 trillion by the end of the year. Probably more than that. $120 billion worth of purchases per month here by the Fed, treasuries, and mortgage-backed securities. So we have mortgages, obviously. Like I said, we have housing at all-time highs, which one would think maybe that's a good thing. You know, prices are up. There's demand for all of these houses. There's a lot of bids on these homes, bidding wars, all this stuff. You would think, well, maybe the Federal Reserve doesn't have to continue to buy mortgage-backed securities. But no, they're continuing to do it. I mean, you can understand why they're going to continue to buy treasuries. Nobody else wants them. They're junk. Uncle Sam's broke. So being the good little central bankers that they are, they're going to buy it up. So you can understand that. But the housing market's supposed to be booming. So why are they buying mortgage-backed securities? You understand? You understand the game that's being played? And of course, this hasn't stopped. We've been doing this crap for 13 years. That's all. Okay. Temporary, though. It's all temporary. Pay no attention to anything else. And of course, M1 and M2 money stock, those definitions were, of course, revised. They are different. M1 now includes savings accounts and money market mutual funds, so that just throws this number completely off the charts. You know, a good thing, I have a couple presentations, capital economics presentations on our YouTube channel and on the capitalnews.com where we have, you know, M1 where it used to be. Of course, I think we can still find that data, but nonetheless, they changed it. So M1 is now at $18,139 billion. Okay, an all-time high. Last week, before the change in definition and calculation, it was about $7 trillion. So that just tells you how much is out there, money market mutual funds, what have you. All right. And then M2 money stock is at an all-time high, or I should say flirting with an all-time high, $19,432 billion. All right. These numbers will continue to march onward and higher as well, because that's what we do here in the Banana Republic. We print the money, we throw it in the system, and we hope for the best. So with all of this sloshing around, with various states and economies starting to open back up, with the vaccine rollout making its way through the days and the weeks and the months, things are going to go back to quote-unquote normal. Okay, so there's going to be a change in spending habits, which just go back to pretty much the way they used to be, to some extent. People are going to go back heavily to bars and restaurants and this, that, and the other. People are going to want to travel, and that's perfectly fine. I don't have any problem with that whatsoever. I want these businesses to thrive and survive, and I want people to do what they want to do. I want them to live their lives, okay? I don't like these lockdowns. But this is only going to have a temporary rush. This is going to be another sugar high into the system, and that is something that Jay Powell was somewhat mentioning this afternoon. That once things open up, there is going to be a surge. Now, again, I don't believe in the pent-up demand story. I just believe these are just simply delayed purchases. You're not going to go out and buy 100 meals at a restaurant because you haven't been there. You're not going to go get 100 haircuts because that's how many you've missed. That's not how it works. But the money is going to make its way back into the economy. It's not, a lot of it is not from productive measures, unfortunately. It's from a printing press, and it's from an out-of-control Congress that can't stop itself. It cannot control itself whatsoever. Okay? And I don't want to hear it that the Republicans are finally taking a stand. No. They had their choice. They had their chance to make a stand with Nobody Cares Act 1.0 and 2.0, and they blew it. They were in power, so it's perfectly fine to run trillion-dollar deficits, multi-trillion-dollar deficits. But now they're not in power. Now all of a sudden they're principled again. Screw these people. I'm sick and tired of them. Leave them. Sickening. And of course, the Democrats don't give a damn. Yeah, just spend it all. Spend it all. And it's not enough. And what I thought was funny, the CBO came out and projected that debt to GDP ratio will be about 200% in the year 2050. which is laughable because according to the U.S. debt clock, we're going to be pretty close to that number in 2025. Okay? 200% of GDP. Again, another statistic to show that we are a banana republic. Is this what you voted for? Is this what you want? Is this what you want for your children, your grandchildren, for your country? Probably not. But this is what you're getting. And people are going to be paying for it. Big time. Big time. And again, when it comes to the argument about inflation, deflation, the inflation's already here. By definition, it's an increase in the money supply. Boom, presto, done, been there, done that, ain't stopping. The question is, where does it go? And I am concerned with the prices of the things, the goods and services that people need. Not necessarily what they want, the little gizmos and gadgets, I really couldn't care less. It's the stuff that they need to survive, because that's what I think it's going to be all about for a decent portion of this decade. Energy costs, they're going up. Commodity costs, commodity prices, metals, they're going up. Food prices, they're going up. All going up. Transportation costs, going up. Still a lot of supply shortages. Still a lot of issues there. This is not going to be rectified anytime soon. This is a perfect storm. It's not going to end well. Jobless up, yields up. So tomorrow we'll talk about the official the official jobs report, and we'll see what that has in store for us. So there you have it. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Carritis. Godspeed.